If you looked at the headlines on Friday morning, June 5th, 2026, you would have seen what looked like fantastic news: a stellar US jobs report. The economy added 172,000 jobs, almost double what economists were expecting. But if you then looked at your brokerage account, you saw a sea of red. The Nasdaq dropped nearly 5%, and the VIX, the market's fear gauge, spiked 39% in a single day. Most people assume that a healthy economy is always good for stocks. More people working means more income, more spending, and higher corporate profits. It feels intuitive that good news for the economy should be good news for your portfolio. But on Friday, the market reminded us of a crucial, often overlooked rule. The stock market doesn't just care about how the economy is doing today. It cares about what the bond market thinks is going to happen tomorrow. While stocks get all the headlines and the excitement, it's the pesky bond market that actually dictates the direction of the whole global economy. Today, I want to clear up the confusion. We are going to use this stellar jobs report to study and understand why bond market reacted by pushing yields to their highest levels in weeks, and why that forced stocks to tank. We will break down the logic chain that connects hiring to interest rates, explain why bond yields are the ultimate gravity for stock evaluations, and look at the specific sectors from memory chips to quantum computing that got hit the hardest. Most importantly, we will discuss how to navigate this healthy pullback using a mix of DCA and a strategic dip buying. Let's look at the numbers first. The US economy added 172,000 jobs in May. Expectations were roughly 80,000. That is a massive beat. And at the same time, unemployment rate held steady at 4.3%. By almost any standard, the labor market is way stronger than anyone anticipated. In a normal environment, this is great, but we are in a fickle market that is obsessed with one thing: the Federal Reserve. The Fed has spent years trying to bring inflation under control. When people have jobs, they earn income. When they earn income, they spend. This creates a stronger demand, giving businesses better pricing power and forcing employers to compete for workers by raising wages. This is the logic chain the market is following. Stronger economic activity makes it harder for inflation to cool as quickly as the Fed would like. One jobs report doesn't change the long-term trend, but it changes the probabilities. Almost immediately, investors reassess the likelihood of a near-term rate cuts. The conclusion: the Fed now has every reason to remain patient and keep rates higher for longer. This is where those pesky bonds come in. As soon as that jobs report hit, Treasury yields spiked. The year 2, the year 10, and the 30-year yields all jumped, with the 10-year reaching its highest level in weeks. There is a common misconception that bond yields just follow whatever the Fed does. In reality, yields are driven by expectations. If investors suddenly believe that interest rates will be higher for longer, existing bonds that pay lower rates become less attractive. And if you own a bond yielding 4%, but the market now expects future bonds to offer 5%, the price of your bond has to fall to remain competitive. Because bond prices and yields move in opposite directions, the yields rise when the bond prices decrease. Why does this matter to you as a stock investor? Because Treasury yields influence everything: mortgage rates, corporate borrowing costs, and most importantly, stock valuations. Think of yields as gravity. When yields rise, the discount rate we use to value future earnings also rises. This makes future profits of high-growth tech companies worth less today. And that is why the Nasdaq, the home of future earnings, go hit twice as hard as the Dow. Semiconductors and memory: Western Digital fell 11% and MRVL dropped nearly 17%. Even the AI darlings like Supermicro saw a 10% correction. Quantum computing: this is the ultimate future earnings play. Rigetti and IONQ both saw double-digit percentage drops. This wasn't a fundamental rejection of AI or quantum technology. It was a valuation reset. The market was frothy, and the spike in bond yields provided the catalyst to bring prices back down to earth. In the long run, this is a healthy development that prevents a 1999-style bubble from forming. So, to recap the chain of events, we have got a stellar jobs report which led to fewer expected rate cuts. which pushed Treasury yields higher, which ultimately acted as gravity, pulling down the stock valuations. The bond market wasn't saying the economy is weak, it was saying the economy is strong enough that we don't need lower rates yet. If you're a long-term investor, don't let this 5% drop scare you. This is a classic healthy pullback in a structural bull market. For your core positions such as QQM or S&P 500, the plan doesn't change. Stay disciplined, keep dollar cost averaging. You are essentially buying the same great companies at a discount compared to last week. However, for individual stocks, especially in the memory and semiconductor space, this spike in yields has created some genuine strategic dip buying opportunities. If the fundamentals of the company have not changed, but the gravity of the bond market has pulled the price down, that is often where the best long-term entries are found. The bond market is complex, but understanding is what separates a retail trader from a sophisticated investor. If you want to start your investing journey right now, Longbridge has some massive welcome rewards for new users based out of Singapore. When you deposit just $2,000, you can enjoy a 10% per annum interest boost plus up for that $2,000. So for tier 1, you can get $80 worth of NVIDIA shares when you deposit SGD 2000 and maintain it for 30 days with 3 trades. Tier 2, you can get $300 worth of NVIDIA shares for a deposit of $10,000 maintained for 90 days with 5 trades. These are some incredible welcome offers. If you sign up using my link in the description below, you can dollar cost average into these ETFs. It's the best way to support the channel and get you through these shaky market conditions. Hit that subscribe button to stay ahead of the curve. I am Rama, and I'll see you in the next one.